Hello, today I have with me Bill Ackman, one of the world's best-known investors and the man behind hedge fund Pershing Square Holdings. Hello, Bill. Thanks for joining me.
Thanks for having me.
The COVID-19 pandemic, it's hit the global economy hard. It still is. Stocks have recovered sharply, though. So the level of recovery has been quite astonishing in some quarters. So is this sustainable? Do you think stocks will keep moving higher in 2021?
So I'll give you a kind of a U.S.-centric perspective, and some of it I think applies globally. The stock market, as I like to say, is not a fair representation of the global economy. It's an important reflection of the global economy, but it doesn't represent the smaller, less well-capitalized, less well technologically enabled companies. Think private, family-owned, smaller, up-and-coming businesses. The S&P 500, for example, represents probably the 500 most dominant companies in the U.S. and in some cases in the world. What COVID has done and what the pandemic has done is it's really disrupted, the companies with bad balance sheets without being technologically enabled have been impaired. Many of them, unfortunately, the smaller ones have gone out of business, whereas the well-capitalized dominant companies have actually improved their market position. So, surviving a pandemic or having the ability to survive a pandemic puts you in a strong competitive position coming out of it. And so you think, simple example, Starbucks is a significant holding. Think about how many fewer coffee shops they're going to be competing against. One of their principal competitors in China, a company called Luckin that was building, very large number of stores every year, turned out to have been a fraud. The tide rolls out, you see who's swimming naked, so to speak. So same thing's really true for Hilton. Hilton is not a hotel company as much of it is a brand where they sell their IP and their brand and their marketing and their millions of customers in a loyalty program to hotels around the world. Well, it's probably more important today for a hotel to have an affiliation with a top brand so that the customer can feel comfortable about for example, their cleanliness standards. The smaller independent hotels are going to be more challenged. So we think, the Hiltons of the world are going to take more market share. And so I do think, we are set up for a very strong recovery in 2021. I think the virus is going to be frightening and a disaster for the next, call it 90, 120 days. So that's the big negative news in the short term. But we have, multiple successful vaccines and probably more coming. We're going to have fairly wide distribution of those vaccines beginning, as early as 30 days from now. And I think by the second half of next year, we'll be probably out of the pandemic for the most part in the first, kind of what you might call first world. And I think you'll be, you have a new president coming in who's going to be very concerned about the economic recovery. So I don't think Biden's going to take any steps to increase corporate taxes, for example, or even personal income taxes. You have Janet Yellen now running the Fed, who's going to be, I think quite supportive of employment and the economy. So you can expect low interest rates. You have, well-capitalized banks. And then you have a large buildup of savings on the part of Americans, and really globally, as people haven't gone out to eat, they haven't gone out to the theater, they haven't gone to a movie, they haven't gotten on a plane, and I would say animal spirits are building up. I don't know about you, but I am. The moment I can actually travel and go places, so I think you're going to see a huge recovery, even in business. If you're any kind of business and you haven't been to see your clients or customers, one of the first things you should be doing is getting on a plane and going to see all your relationships, because if your competitor is going to be doing it. And so I think you're going to see a fairly rapid recovery beginning sometime late Q2, Q3, Q4. Low interest rate environment, a ton of savings to be deployed. It could be pretty favorable. And then you have a lot of companies that use the crisis to kind of tighten up their cost structure. Hilton cut, I think, something like 25 to 30% of their corporate overhead costs, and success does breed a certain looseness with expenses, and a crisis does the opposite. So you can have some leaned up companies coming out into a very strong environment. So I think there's a pretty good chance for a very strong stock market next year.
Okay, well that's good news. Your fund particularly is very concentrated, as you've already mentioned. How do you reconcile the extra risk of having so few holdings with the potential reward?
Sure. So Buffett describes, he says, diversification is protection against ignorance. So if you don't know what you want to own a lot of things. Our business is different. we own 10 things. We tend to own them for years. We have some holdings we've owned for a dozen years, some 8 years, 4 years, 6 years. We're looking for businesses we can own for. The whole goal behind getting permanent capital is we never wanted to be forced to sell something because of investor capital flows. We're now in that position as 87% of our assets are in Pershing Square Holdings. So, so one, we have the time to do our homework. We might identify 1 or possibly 2 new investments a year. Second, of course, these are businesses we've gotten to know quite well over time. But most importantly, we've selected businesses for their inherent robustness, right? So almost all of our companies are strong investment grade companies. So there's not a balance sheet threat to the businesses we own. They tend to be very dominant, whether it's Hilton or Starbucks in their respective industries. So they're an important, dominant, large cap business. They're in businesses that we can understand, and they're businesses that we think are not at great risk of disruption. And that we spend big part of our job is saying how we're looking for the highest quality businesses in the world. And so if you own 10 stocks that were sensitive to energy prices or interest rates or regulatory risks, or they had highly levered, then you've got enormous risk. If you own 10 incredible businesses with strong balance sheets and excellent management teams, and you're a large influential shareholder, so you can encourage them to do smart things, and you can discourage them or prevent them from doing things that would be destructive, you're actually better off owning a concentrated portfolio and owning the 10 best things you can find than even owning 20 things where we're not going to, ideas 11 through 20 are not going to be as good as ideas 1 through 10. And that's really the strategy.
Yeah. Your fund is US focused, but I'm really interested to hear what you've got to say about the UK as an investment destination. What do you think? Is it investable now, or when we have more information on Brexit? It's clearly having an impact on the currencies at the moment. What's your view on the UK?
I would say I'm not a domain expert on the UK. I certainly enjoy coming to the UK as a tourist, and obviously occasionally on business. But I'm not sure I could give you a particularly keen insight. All of that being said, all the same things I said about the US are really true in the UK. And what you didn't have the same election uncertainty we did with the president. I think the Brexit uncertainty is kind of the same thing. So I think Brexit being resolved, frankly, one way or another, will lift a cloud of uncertainty. And then you have the same, I assume the Brits have the same animal spirits we do in terms of getting out and going to the pub and going for dinner and getting on a plane and traveling. And so I think you're going to see a global economic recovery and a reduction in uncertainty. And the combination of those things should be good for stocks.
And are you a believer in the sort of the Tina effect? There is no alternative to equities. Clearly, with interest rates at next to nothing, where else do you put your money?
Yeah, I agree. I'm not a fan of buying bonds of any kind at current interest rate levels. You think about a long-term instrument. Today the 30-year Treasury is at 1.3%. Right? When we think about a company. So for example, Lowe's is trading at something like 18 times earnings. If you flip over the PE multiple, that's something north of a 5%. Call it a 5.5% earnings yield. Which would you rather own? Lowe's at a 5.5% earnings yield, where that yield is going to grow at a pretty high rate. We think mid-teens or higher rate for the foreseeable future. Then buy a company that's generating an earnings yield of 1.3% and it's stuck there for 30 years and there's no potential for upside. I mean, that's the bond equivalent. And so I think equities are by far the superior alternative. What are people looking at? They're investing in Bitcoin, which is a much more complicated question. But I feel very comfortable owning 10 phenomenal businesses. If the stock market shut for 10 years and we woke up 10 years from now, those companies would be a lot more valuable. And you can't say the same thing about bonds. I do think interest rates are largely bounded by zero, not entirely bounded by zero, but betting on rates going negative is a short-term trade, not a long-term one.
Bill Ackman, Pershing Square Holdings. Thanks very much for joining me today.
Thank you so much. Appreciate it.